patubas ang batas, pag-aralan
execution. Both, you need the communication and monitoring. As simple as that.
Mandato ng Philippine Institute for Development Studies o PIDS na gumawa ng mga pag-aaral at pananaliksik ng mga polisiya at programa ng pamahalaan at magbigay ng rekomendasyon sa mga mambabatas sa pagbabalangkas ng mga polisiyang makakatulong sa ating bansa. Sinusulong ng aming ahensya ang evidence-based policy making upang bigyan din ng kahalagahan ng polisiya na batay sa datos at policy research na sumusuri sa tunay na kalagayan ng ating mga komunidad. Napakahalaga ng policy research, lalo na sa mga panahong dumadaan sa krisis ng ating bansa.
Kapag polisiya ay pinag-aralan, susulong ang bayan.
In need of references for your research? Do you want a digital library that you can access for free anytime and anywhere? You don't have to look far. SERP-P is here for you. SERP-P is an online database of socioeconomic materials produced by the Philippine Institute for Development Studies. Government agencies, research and academic institutions, and international organizations based in the Philippines. It is the country's first online repository of socioeconomic information, created for policymakers and development practitioners, researchers, educators, and students. To access SERP-P, just visit the PIDS website and click the SERP-P widget under the Databases tab, or type serp-p.pids.gov.ph. SERP-P has a wide variety of materials such as journal articles, books, research papers, working papers, policy notes, audiovisual materials, and more. As of 2022, SERP-P has more than 60 partner institutions contributing knowledge resources to the database. SERP-P provides a comprehensive coverage of references encompassing 22 research themes: labor and education, gender and development, poverty, technology and innovation, trade and industry, and many more. On the enhanced website of SERP-P, you can filter your research by keyword or author, publication type, research theme, or year published, all at the same time. SERP-P has more than 7,000 publications and audiovisual materials that you can access and download for free. What are you waiting for? Visit SERP-P now. Socioeconomic Research Portal for the Philippines, innovating knowledge exchange and policy research.
So what is PIDS? For over 40 years, the Philippine Institute for Development Studies, or PIDS, has been the country's foremost socioeconomic think tank. It conducts rigorous and objective policy research and analyses that help the government in crafting relevant policies, plans, and programs in support of the country's long-term vision and development goals. PIDS pursues its mandate through three basic programs: research, dissemination, and outreach. Through its research program, PIDS identifies and prioritizes studies, develops proposals, and conducts research on priority areas. The results of these studies are then disseminated through different platforms, publications, online resources, PIDS Corner, seminars, and the Development Policy Research Month, or DPRM, held every September. To shed light on key policy issues, the advice and expertise of the Institute's research fellows are also sought by policymakers, government agencies, private sector, and civil society. Since 1977, PIDS has completed numerous policy studies on a wide range of development topics. This brand of service has then translated to policies and programs that have improved the lives of every Filipino. Philippine Institute for Development Studies, service through policy research.
dapat po munang alamin or matukoy ang pangunahing problema ng bansa upang mapagtuunan ng pansin at mabigyan ng solusyon.
We should have specific goals, do research, and make a policy that is fair for everyone.
Walang problema sa pulisiya. Iayos lang ang pagpapatupad.
Bago patubas ang batas, pag-aralan muna gusto ng government.
Two things, clarity and execution. Both, you need the communication and monitoring. As simple as that.
Mandato ng Philippine Institute for Development Studies o PIDS na gumawa ng mga pag-aaral at pananaliksik ng mga pulisiya at programa ng pamalaan at magbigay ng rekomendasyon sa mga mambabatas sa pagbabalangkas ng mga pulisiyang makakatulong sa ating bansa. Sinusulong ng aming ahensya ang evidence-based policy making upang bigyan diin ng kahalagahan ng pulisiya na batay sa datos at policy research na sumusuri sa tunay na kalagayan ng ating mga komunidad. Napakahalaga ng policy research, lalo na sa mga panahong dumadaan sa krisis ang ating bansa.
Kapag pulisiya ay pinag-aralan, susulong ang bayan.
In need of references for your research? Do you want a digital library that you can access for free anytime and anywhere? You don't have to look far. SERP-P is here for you. SERP-P is an online database of socioeconomic materials produced by the Philippine Institute for Development Studies, government agencies, research and academic institutions, and international organizations based in the Philippines. It is the country's first online repository of socioeconomic information, created for policymakers and development practitioners, researchers, educators, and students. To access SERP-P, just visit the PIDS website and click the SERP-P widget under the Databases tab, or type serp-p.pids.gov.ph. SERP-P has a wide variety of materials such as journal articles, books, research papers, working papers, policy notes, audiovisual materials, and more. As of 2022, SERP-P has more than 60 partner institutions contributing knowledge resources to the database. SERP-P provides a comprehensive coverage of references encompassing 22 research themes: labor and education, gender and development, poverty, technology and innovation, trade and industry, and many more. On the enhanced website of SERP-P, you can filter your research by keyword or author, publication type, research theme, or year published, all at the same time. SERP-P has more than 7,000 publications and audiovisual materials that you can access and download for free. What are you waiting for? Visit SERP-P now. Socioeconomic Research Portal for the Philippines, innovating knowledge exchange and policy research.
So what is PIDS? PIDS has been the country's foremost socio-economic think tank. It conducts rigorous and objective policy research and analyses that help the government in crafting relevant policies, plans, and programs in support of the country's long-term vision and development goals. PIDS pursues its mandate through three basic programs: research, dissemination, and outreach. Through its research program, PIDS identifies and prioritizes studies, develops proposals, and conducts research on priority areas. The results of these studies are then disseminated through different platforms, publications, online resources, PIDS Corner, seminars, and the Development Policy Research Month, or DPRM, held every September. To shed light on key policy issues, the advice and expertise of the Institute's research fellows are also sought by policymakers, government agencies, private sector, and civil society. Since 1977, PIDS has completed numerous policy studies on a wide range of development topics. This brand of service has then translated to policies and programs that have improved the lives of every Filipino. Philippine Institute for Development Studies. Service through policy research.
Welcome to the PIDS webinar series. Before we start our virtual event, we have some reminders. For attendees, your microphone is automatically muted upon entry. Type your question and click send. For Facebook viewers, you may send your question using the comment section. Remember to keep your questions concise and direct to the point. We will screen all questions to ensure that they are relevant to the webinar topic and the presentation. The moderator will read the questions during the open forum and cover as many as possible depending on the available time. This webinar is being recorded and live streamed on the PIDS and SERP-P Facebook pages. The recording will also be made publicly available on the PIDS YouTube channel. Thank you for joining us, and we look forward to your active participation.
Good morning, everyone. It is a pleasure to welcome you to the Philippine Institute of Development Studies' first public event of the year, Macroeconomic Prospects of the Philippines in 2025. I am Melinda Quinones, your guest host and moderator for today's session. This webinar will examine the country's economic outlook and the role of fiscal policy in promoting sustainable growth. We will explore two key studies, one on major economic drivers like consumer demand and infrastructure investments, and another on the Macroeconometric Model assessing the impact of government revenue, spending. Feel free to ask questions, share your thoughts, and interact with Live comment section. To formally start our program, let us welcome PIDS President Dr. Aniceto Orbeta Jr. for his opening remarks.
Good morning, everyone, and welcome to our first public webinar this year titled Macroeconomic Prospects in the Philippines in 2025. It is my pleasure to begin by acknowledging the presence of the distinguished guests and officials. National Economic Development Authority Assistant Secretary Agnes Tolentino, National Poverty Commission Undersecretary Gerald C, Department of Finance Undersecretary Durutan Tiusico, Department of Finance Assistant Secretary Nila Adrian Cabilis, Philippine Statistical Research and Training Center Institute Executive Director Josefina Almeida, Department of Interior and Local Government Academy Executive Director Telma Dicina, Bureau of Treasury Director Robert Dominic Mariano, Rivera Alliance for Autonomy, Peace and Development Incorporated President Milagros Rimando, Philippine Foundation for Equity in Health and Executive Director Theo Prudencio Juani Capindi, and Lorma Community Development Foundation Incorporated Executive Director Andrew Cesar Rimando, Philippine Exporters Confederation Incorporated Vice President Maria Floresa Leong, and Philippine Business for Social Progress Incorporated Executive Director Ilvin Ivan Oy. I also like to warmly welcome the representatives from government, academe, private sector, civil society, and media joining us virtually today, and those watching live through the PIDS and SERP-P Facebook pages. Over the past decade, the Philippines has consistently ranked among the Southeast Asian top economic performers, demonstrating resilience and stability. In 2024, the country recorded 5.6% growth in gross domestic product, GDP, driven by strong domestic consumption, expanding job opportunities, and steady remittance inflows. Overseas Filipino workers contributed over 2.8 billion in remittances in November 2024, while foreign direct investment reached 1 billion by the fourth quarter. The industry and services sectors grew by 5.6 and 6.7% respectively, while agriculture, forestry, and fisheries contracted by 1.6%. Despite these gains, the GDP growth rate fell short of the government's 6 to 6.5 target, as the impact of destructive typhoons dampened the usual surge in economic activity during the holiday season. Nevertheless, PIDS remains optimistic, projecting a 6.1 year-on-year GDP growth for 2025. This outlook is supported by rising household consumption, improved employment conditions, stable remittance inflows, and increased election-related spending. If the country sustains its momentum through strategic investments, policy reforms, and a favorable economic environment, it remains on track to achieve upper middle income status. This objective aligns with the previous year's Development Policy Research Month theme, which emphasized the need for greater productivity, inclusive growth, and human capital development. While fundamental economic indicators remain strong, persistent challenges such as income inequality, underemployment, and limited social mobility continues to hinder progress. To ensure sustainable and equitable development, economic gains must translate into meaningful improvements in the quality of life for all Filipinos. In this regard, today's discussion will highlight key findings and recommendations from PIDS studies, offering insights into the country's macroeconomic landscape and the critical role fiscal policy in driving long-term sustainable growth. Our first speaker is former Supervising Research Specialist John Paul Corpus, who will discuss the study Let's Get Fiscal, extending Small Macroeconometric Model of the Philippines Economy. This research paper introduces a small macroeconomic model with a fiscal sector, including equations for government revenues, expenditures, and debt, alongside four components on domestic demand, trade, employment, prices, and monetary sectors. PIDS Senior Research Fellow Dr. Paolo Rivera will next present his study, Macroeconomic Prospects for the Philippines in 2024-2025, toward upper middle income status. The study explores the key drivers of the country's strong domestic growth, including robust consumer demand, increased infrastructure investments, and a flourishing service sector. To provide expert insights and perspective, we are honored to have Security Bank Vice President Angelo Taninco and SM Investment Economist Robert Dan Roses as our discussants. I encourage everyone to stay until the end of the webinar and actively participate in the open forum later. Your questions and contributions will undoubtedly enrich today's discussion. Thank you very much, and we look forward to having you join us in the succeeding webinars this year. And now turn the floor to our guest moderator, Ms. Quiñones.
Thank you very much, Dr. Arbeta, for setting the stage for today's discussion and highlighting the Philippines' economic resilience and the importance of fiscal policy and investments in driving growth. These are the key topics we will dive into in this session. But before we proceed, let us start with a quick poll to hear your thoughts on the biggest risks for 2025. So here's the question. What risks are you most concerned about this year? I repeat, what risks are you most concerned about this year? So we have quite a few items here that you have to rate. A, high inflation and interest rates. B, political instability and governance issues. C, peso devaluation and currency fluctuations. D, geopolitical and West Philippine Sea tensions. Or E, unemployment and livelihood risks. So for those on Zoom, kindly click the link posted in the chat box. For our Facebook Live viewers, you'll find the link in the comment section. So the poll question on your screen connects to today's discussion from a macroeconomic perspective. The identified risks, such as inflation, governance issues, currency fluctuations, geopolitical tensions, and unemployment, are all contributing or impacting economic growth, investment strategies, and policy decisions. So we now have 252 Zoom attendees and 33 live viewers on PIDS Facebook page. We encourage you all to take part in answering the survey. Okay, so we have 87 respondents. Keep it coming. Okay, so let us take a look at the results. Team, please display the poll findings, please. Okay, there you go. All right, so in our Mentimeter, we have 23 voted, or 26 who voted for high inflation and economic interest. 62 said political instability and governance issues, very timely. 7 says peso devaluation and currency fluctuation. Well, 8, we have geopolitical and West Philippine Sea tensions. And 13 for unemployment and livelihood risks. All right, so thank you for participating. Let us now proceed with the presentations. As Dr. Urbeta mentioned, today we will hear 2 key PIDS studies. So the first presentation is based on the PIDS study, Let's Get Fiscal, extending the Small Macroeconometric Model of the Philippine Economy, by former PIDS Senior Research Fellow Margarita Debuque-Gonzales and former Supervising Research Specialist John Paul P. Corpus. So their research paper presents a small macroeconometric model with a fiscal sector, extending the model they created in 2023. So the updated model includes equations for government revenues, expenditures, and debt, complementing core components on domestic demand, trade, employment, prices, and monetary sectors. It demonstrates strong predictive accuracy and simulates the fiscal impacts of shocks such as changes in oil prices, exchange rates, and government spending. Our presenter, Mr. John Paul Corpus, is a former PIDS Supervising Research Specialist who has worked on macroeconomic policy, financial inclusion, social protection, and youth unemployment. He is pursuing a master's in globalization and development at the Institute of Development Policy of the University of Antwerp in Belgium. But he cannot join us live today. So he has prepared a recorded presentation. So I enjoyed everyone. So please watch this video.
Hello everyone, it is my pleasure to share with you today the results of the macro modeling exercise that Dr. Maggie Gonzalez and I conducted for PIDS in 2022. The model in this presentation is an extension of the small macroeconometric model that we built in the middle of 2022. This effort to build a macro model within PIDS was a response to the scarcity of the Philippines that can be used for policy analysis. Our goal was to build a model that can be used for policy analysis with a good degree of forecasting power. And our strategy was to start with a small and simple demand-side model that can serve as the core for building a larger and more complex model of the economy. The philosophy that we adopted was to be pragmatic, which means that we sought to balance theoretical rigor with empirical realism. And at the end of 2022, we managed to extend that small model by adding a fiscal sector. This proved to be timely because of urgent issues that affected the country's fiscal health at the time, including rising fiscal deficits and the buildup of debt due to the pandemic crisis, rising interest rates, and the sharp depreciation of the peso. The small macro model is composed of 6 blocks or sectors, namely domestic demand, trade, employment, prices, monetary or financial, and fiscal. It consists of 38 equations, of which 18 are behavioral and 20 are identities. We use quarterly data from the first quarter of 2002 to the fourth quarter of 2019. Although data from the pandemic years of 2020 to 2021 were already available at the time, we decided to exclude them due to the unusual economic conditions of the period. And we use the ARDL-ECM method to estimate the behavioral equations in order to capture both short-run and long-run relationships in our variables. So this diagram the relationships between the variables. But to get a more complete picture of these relationships, I invite you to read our discussion paper, which is available on the PIDS website. The domestic demand block consists of consumption, investment, government consumption, and GDP. While world GDP is taken as an exogenous variable. The employment block consists solely of the employment rate, which depends on GDP. The price block consists of CPI and inflation rate. CPI depends on the world price of oil and the price of rice, both of which are considered exogenous. The monetary or financial block consists of the real exchange rate, the central bank policy rate, short-term and long-term treasury rates, and the bank lending rate, the inflation target, and the peso-dollar exchange taken as exogenous. And finally, you have the fiscal block, which consists of revenues, expenditure, and debt. This diagram shows the fiscal block in greater detail. On the revenue side, revenues are disaggregated into tax and non-tax revenues, and tax revenues are further disaggregated into internal tax revenues and customs revenues. Internal tax revenues and non-tax revenues depend on GDP, while customs revenues depend on imports, the world price of oil, and the exchange rate. On the expenditure side, expenditures are the sum of primary expenditure and interest payments. Primary expenditure reacts to total government debt, while interest payments also depend on the level of debt as well as on interest rates. Domestic and foreign interest rates on debt depend on the benchmark long-term domestic and foreign treasury rates. On interest payments, the exchange rate, the debt stock from the previous period, and the primary balance. Again, for a closer look at these relationships, I invite the audience. Historical data, we perform in-sample simulations over the period Q1 2012 to Q4 2019. We produce both static forecasts and dynamic forecasts, and we evaluate forecast accuracy using the usual indicators, which are the mean absolute percentage error, or MAPE, for level variables, and mean absolute error for percentage or rate variables. We give greater attention to forecasts for GDP growth and inflation rate. Here we see that the model's dynamic inflation forecasts do a better job in mimicking the actual data compared to its GDP growth forecasts. This slide shows the model's forecasts for the central bank policy rate and for the nominal and real treasury and bank lending rates. We find that the dynamic forecasts for the central bank policy rate is unable to mimic the stepwise movement in the actual data, but it does a fairly good job at capturing the turning points, and it stays rather close to the actual data. Meanwhile, the dynamic forecasts for nominal interest rates perform a bit worse in capturing the data, but dynamic forecasts for real interest rates do a better job because of the more accurate inflation forecasts. Turning to our revenue variables, our dynamic forecasts perform quite well, with most having MEPs below 5% or slightly higher. The exception here is non-tax revenues, with forecast MEPs of slightly over 15%. On the expenditure side, we find that the model's dynamic forecast for primary expenditure performs better than its forecast for interest payments. This reflects the divergence observed in our debt forecasts, which we will see in the next slide. Finally, here are the model's projections for government debt and primary balance. We see here that the dynamic debt projections diverge from the actual data starting in 2014, and this is due to the large downward errors in our primary balance forecasts for 2014 and 2015, which were then absorbed into the debt forecast. Apart from assessing the model's forecast performance, we also tested how endogenous variables behave when temporary shocks are introduced into the system. So we considered the effect of 3 shocks to the model. The first one is a world oil price shock, which is a 20% increase in world oil prices from their actual value in 2013. The second one is a shock in primary spending, which is a 10% increase in primary spending from its baseline path in 2013. And third is an exchange rate shock, which is a 10% depreciation of the peso versus the US dollar relative to the actual exchange rate in 2013. However, because of time constraints, we are only going to discuss the first 2 shocks, but we invite those who are interested to read the paper to learn more about our simulation involving the exchange rate shock. We first consider the effect of a world oil price shock. In these graphs, the blue lines represent the deviation of the paths of the variables when there is a shock compared to their baseline paths without a shock. The deviations are in percentage terms for level variables and in percentage point terms for rate and percentage variables. Here we see that the higher price of oil triggers faster inflation in the first year, which rises above the baseline. This leads to an increase in the central bank policy rate and subsequently in nominal market interest rates. But inflation also causes real interest rates to fall below the baseline. Private investment and consumption initially go down because of the price hikes, and exports also go down because of the appreciation of the real exchange rate. These forces combine to reduce GDP growth. However, inflation begins to slow down by the following year, which causes real interest rates to rise, and which causes investment and consumption to go down further. But investment and consumption eventually recover because of softer inflation and a decline in real interest rates. Exports also recover because of the weakening of the real exchange rate. On the fiscal side, the oil price shock causes total revenues to increase due to higher customs revenues. As a result, the primary balance improves and the debt level declines. The wider fiscal space allows primary spending to rise 1 year later, which then eliminates the improvement in the primary balance. Next, we consider the impact of a temporary 10% increase in primary spending. In this experiment, it is important to note that we shut down the mechanism which makes primary spending react negatively to rising debt. The primary spending shock leads to an increase in government consumption, which raises domestic demand. Higher domestic demand causes inflation to pick up, which then triggers monetary tightening by the central bank. This then leads to a rise in nominal market interest rates. However, real interest rates fall, which then promotes greater investment and consumption spending and faster GDP growth. The increase in GDP growth begins to fade away in the following year. This is because government consumption normalizes, and at the same time both investment and consumption spending fall because of the recovery of real interest rates. On the fiscal side, faster GDP growth leads to an increase in revenues. However, the increase in spending outstrips the revenue improvements, and this causes the worsening of the primary balance. However, the primary balance eventually returns to the baseline after the shock. But the borrowing that was incurred during the shock period leads to a permanent increase in the debt stock. In conclusion, we believe that the addition of a fiscal block to the small model is a step closer to a macroeconometric model that is useful for policy simulation and analysis. Our in-sample forecasts show acceptable levels of forecast accuracy, although much can still be improved. And our impact simulation exercises also show that the model can be useful for analyzing the effects of exogenous shocks and policy changes. The model is still a work in progress, and the next steps for model development can include the following. First is adding a more detailed financial sector. Second is modeling the aggregate supply side of the economy. Third is strengthening linkages between blocks. Fourth is incorporating the role of expectations. And fifth is including key features of the Philippine economy, such as remittances and the BPO sector. Thank you everyone for taking the time to listen to my presentation, and I hope you all have a nice day.
The macroeconometric model tests responses to shocks as it was presented to us by Mr. Corpus. World oil price, exchange rate, and primary spending. If you want to learn more about the model, you can download the study in the PIDS website. So it provided us a more reliable model for understanding and predicting economic outcomes. Thank you, Mr. Corpus, for such a comprehensive presentation. We know some of you have questions or need some clarification, so please type them in the Q&A box. Our team will collect them and send them to Mr. Corpus so he can respond to them via email. So moving on, let us hear from our next presenter. Our second presentation is based on the PIDS study, Macroeconomic Prospects of the Philippines in 2024 to 2025 toward upper middle income status by PIDS Senior Research Fellow Dr. John Paolo Rivera, a research specialist Mark Gerald Ruiz, and research analyst Ramona Maria Miral. So this study examines the key drivers behind the country's strong domestic growth, rising consumer demand, infrastructure investments, and a thriving service sector. It highlights the Philippines' rapid recovery with real per capita GDP returning to pre-pandemic levels within just 4 years, a remarkable achievement compared to past crises. So we are privileged to have one of the authors with us today to present this study. Let me introduce him. Our presenter is a distinguished economist specializing in macroeconomics, development economics, management, and tourism. He holds a PhD in economics and has extensive experience in research in academia and consulting for the public and private sectors. He founded Oeconomia Advisory and Research Incorporated, and he was a visiting research fellow at Ritsumikan Asia Pacific University and previously led the AIM Dr. Andrew L. Tan Center for Tourism. Currently, he is a senior research fellow at the PIDS and was recently named the 2024 Outstanding Young Scientist in Economics by the DOST National Academy of Science and Technology. Ladies and gentlemen, let us welcome Dr. John Paolo Rivera. Dr. Rivera, you may now take the virtual floor.
Okay, good morning everyone. I hope I can be heard clearly. Magandang umaga po sa ating lahat at maayong buntag sa tanan. On behalf of PIDS, I thank you for your interest and participation in this webinar on macroeconomic prospects for 2024-2025 for the Philippines. And this report that we would be delivering has been prepared by yours truly and Mr. Mark Ruiz and Ms. Ria Miral, who's joining us later on. You will see them later on. Okay, and this report, while this report has been completed in October 2024 and released subsequently the following month, a lot has happened in the Philippine economy since December 2024 up to actually today, February 2025. And incorporating the recent developments in the Philippine economy as we ushered in to 2025, discussing macroeconomic prospects remains to be a pertinent topic as we look into the insights on investment landscape, identify potential growth opportunities, and of course, address risk and strategic considerations. And actually, I'm grateful for our discussants later on, both from the private sector to supplement our strategies in navigating these macroeconomic challenges. And for this particular presentation, we would be touching on 3 areas, namely macroeconomic fundamentals. So it's an economic overview of Philippine and global economic landscape, major local and global current events impacting Philippine investments, and finally, key trends in the Philippine market. However, due to time constraints, we would not be able to cover the entirety of the report we have prepared for you, but you may find the full copy of the reports through the PIDS website and through the link provided. And likewise, the slide deck would be made available in the PIDS website. So to begin our discussion, we pose the following inquiries to guide our narrative. So these are 3 important questions that we would like to address at the end of this presentation. Mga importanteng katanungan na dapat nating sagutin pagkatapos nito. Una, what has happened to the Philippine economy in 2024? What will happen to the Philippine economy 2025 onwards? Second, is the Philippines back to its pre-pandemic growth trajectory? And third, very pressing question. How can the Philippines achieve upper middle income status in the succeeding years? So let's begin with the Philippine economic overview. First and foremost, let's look at GDP. Okay. So recently, now the actual figures have been released. So the Philippine economy grew slower than expected in 2024, reflecting weaker external demand, high borrowing costs, and government underspending in the first half of 2024. So while household consumption remained resilient, inflationary pressures and elevated interest rates dampened everyone's purchasing power. The manufacturing sector saw also sluggish growth, and foreign direct investments remained subdued despite investment pledges from overseas trips. However, the good thing about this is that services and infrastructure spending help cushion the slowdown. And moving forward, monetary easing, strong public spending, and improved global conditions could support a better growth outlook in 2025 onwards. But we also need to look into agricultural development to reinforce the contribution of the sector that will systematically address our food insecurity issues, food inflation, and of course, employment in the agricultural sector. Because if you can see on the statistics released by PSA recently, the agricultural, fisheries, and forestry sector registered a contraction for 2024. We can do a lot of things to be able to expand the contribution of agriculture. Now, zooming in on the Q4 performance, so the Philippine economy posted a moderate GDP growth for the last quarter of the year, but it lagged behind some of our ASEAN neighboring economies, of course, due to persistent inflationary threats, high borrowing costs, and weaker external demand. And while domestic consumption and government spending provided support, manufacturing and exports underperformed compared to our regional counterparts like Vietnam and Indonesia, which benefited from stronger trade recovery and industrial activity. Now, while the Philippines' growth was still higher than Thailand and Malaysia, global demand uncertainties weighed more heavily. So the reasons for the economic growth slowdown, not really slowdown, but the below expectation growth rather, could also be traced to adverse weather conditions, global economic challenges, persistence of inflationary pressures, the high interest rate environment, and export decline. So the government is driving inclusive economic growth by creating quality jobs, managing food inflation, and accelerating infrastructure projects in collaboration with local government units and PPPs. Efforts to enhance the business climate, enhance trade partnerships, and strengthen manufacturing aim to attract more investments. Additionally, support for agriculture, as what I have emphasized earlier, tourism, and social protection programs will ensure that broader economic benefits are there while positioning the Philippines for sustainable growth. Now let's look at this one, this very interesting chart regarding the Philippines per capita GDP, which is the measure for whether we're going to transition towards upper middle income status. Okay, so the Philippines per capita GDP has actually rebounded from a very sharp contraction during the COVID-19 pandemic. But whether it has fully regained its long-term growth trajectory since the 1980s remains debatable. Okay? So while economic growth has been positive, it has not consistently reached the high levels needed to outpace population growth and achieve sustained improvements in living standards, thereby allowing the Philippines to transition towards upper middle income status. And why is that the case? several structural challenges persisted through the years, including productivity constraints, investment bottlenecks, and a reliance on consumption-driven growth rather than high-value industries and investments. So we emphasize here that growth in the economy may not just be driven by consumption, but can also be driven by high-value production, industrialization, and investment inflows. Additionally, external inflationary pressures and geopolitical uncertainties continue to pose challenges. And to fully recover and sustain long-term growth paths, our country must accelerate infrastructure development, of course, attract more high-quality investments, and strengthen the manufacturing, tech sectors, and move forward with agricultural development. Of course, finally, invest on skills development. Only then can our per capita GDP trajectory can move past historical cycles of boom and bust. Growth will be able to achieve a higher sustained trajectory for the succeeding years and decades to come. So that's for GDP. Let's look into inflation. But I would like to make a qualification here that this slide is looking into the Philippine headline inflation rate for 2024, which has remained a key economic concern, reflecting efforts to stabilize costs and manage the movement of prices. And in 2024, while inflation showed signs of moderation compared to 2023, fluctuations in food and energy prices, supply chain disruptions, and external shocks pressures it to be elevated at times. And the Bangko Sentral ng Pilipinas maintained a cautious monetary policy stance, balancing the need to tame inflation while, of course, supporting economic growth. And moving forward, food security measures, energy stability, and structural reforms will be crucial in ensuring inflation remains to be manageable within the healthy economic range and does not erode household purchasing power. So that's the trend of our headline inflation rate. But then there's this another component of inflation which we call the core inflation. Okay, so the Philippine core inflation rate for 2024 remained elevated. But similar to headline inflation, it has also showed signs of easing compared to previous years. But maybe you're asking, no? So what's the difference between headline inflation and core inflation? Headline inflation, what I have shown you in the previous slide, is simply the total inflation for the period comprising the basket of commodities. Differentiating it with core inflation, we simply remove the volatile goods in that basket, such as food and beverages, fuel, light, energy, okay, from that basket of commodities. And since prices of these products change daily, they are removed, so the core CPI is deemed to be more stable. So we can see there, if the core inflation is increasing, it means that those commodities, which is expected to have stable prices, their value, their prices are actually increasing. Okay, and of course, similar to our analysis of the headline inflation, the BSP continue to maintain their cautious monetary stance so that they can balance inflationary targeting, inflation management, balancing it with economic growth, with our goal for a long-term economic growth and resilience. There. And I just wanted to share with you that the basket that I was talking about earlier is comprised of these goods. Okay, and you can see here that Philippine inflation rate for 2024 varied across key commodity groups. It reflects different price pressures on different commodity groups throughout the year. And we can see that in summary, food and non-alcoholic beverages remained a major driver of inflation, with rice prices surging due to supply constraints. That's why I have been emphasizing on agricultural development so that we can also address food insecurity and food inflation. Okay, and housing Water, electricity, and fuels also saw fluctuations influenced by global energy prices and local utility adjustment. For transport inflation, it has remained relatively stable, benefiting from certain declines in global oil prices, but they're still affected by fare adjustments and other logistical costs. Health and education services recorded mild price increases, reflecting rising costs in medical care and private schooling. For recreation, culture, and restaurants, they saw higher inflation driven by increased consumer spending and tourism recovery. Now, in the previous years, we have this term called revenge travel. That when destinations were opened, people suddenly spent on tourism, hospitality, and recreation. And while overall inflation showed signs of easing in late 2024, food and energy prices remained volatile, underscoring the need for supply-side interventions and policy support to stabilize costs. Now, let's look into the behavior of interest rate, of the policy rate by the Bangko Sentral ng Pilipinas. In 2024, as what I have mentioned earlier, the BSP has maintained a cautious monetary stance, keeping the policy rate elevated for most of the year to anchor inflation expectations and ensure price stability. However, as inflation showed signs of easing and global monetary conditions are now shifting, the BSP has signaled a potential rate cuts. With the news have reported that we're expecting a total of 50 BPS or basis points in reduction expectation by year end. And this policy shift is technically aimed to support economic growth, ease borrowing costs for businesses and enterprises, as well as consumers. And this also aligns with global central banks' more accommodative stances. However, as we all know, BSP is very cautious. BSP has remained to be data-driven, data-dependent, balancing growth support with the need to manage currency stability together with inflationary risks. So in the Philippines, I just wanted to share this graph that inflation and interest rates typically move in tandem. And as the BSP adjusts its policy rate in response to inflation trends, we can see that when inflation rises, the BSP hikes interest rates to curb demand, the demand side inflation, and stabilize prices. Conversely, when inflation eases, the BSP would also tend to lower rates to stimulate borrowing and investment. In 2024, this dynamic between the interest rates and inflation rate played out as the BSP kept rates elevated early in the year to tame the inflationary pressures at the beginning of 2024. But later, signaled potential rate cuts as inflation has been cooling. Again, this balancing act reflects BSP's data-driven approach, ensuring that inflation remains within target, within healthy bands, while supporting economic growth. Now let's look into employment. So the Philippines employment rate in 2024 remained relatively stable, which is a good news. It reflects a resilient labor market despite the economic headwinds. Job creation was supported by growth in services, tourism, and manufacturing. Though challenges such as elevated inflation and global uncertainties influence labor conditions. Now, while unemployment remained low, underemployment persisted. Now, the persistence of underemployment or those working below 8 hours or those working on jobs that they were not trained for, this highlights the need for higher quality jobs and better wages. Government efforts to boost investments, infrastructures, and skills development are, of course, aimed to enhance job opportunities and drive inclusive growth. So that's for employment. So I just wanted to share this with you that in the Future of Jobs Report 2025 by the World Economic Forum, The fastest growing and declining jobs by 2030 would include, no, for the top fastest growing jobs would include big data specialists, fintech engineers, AI and ML specialists, software and application developers, all of which you can notice that they are related to technological development. For the top fastest declining job, according to the World Economic Forum, would include postal service clerks, data entry clerks, administrative positions, and so on and so forth. So these are the jobs that would require certain retooling, updating, so that they are able to catch up with the recent technological development that we have, therefore providing them with higher skills to adapt to changing technology. Now let's go to FDI. Okay. Foreign direct investments inflows to the country in 2024 also face headwinds, with net inflows declining year over year amid global economic uncertainty, the high interest rate environment, and the cautious stance by many investors. So while manufacturing, IT, BPM, and renewable energy sectors attracted capital, challenges such as regulatory hurdles and infrastructure gaps dampened that momentum. But despite this, okay, the government continued to push for investment-friendly reforms, including the Create More Act and expanded free trade agreements. So the Philippines is now a member of the Regional Comprehensive Economic Partnerships, and we have been strengthening our economic activities with the ASEAN Economic Community. And all of these are to enhance our country's competitiveness. Now, the outlook remains cautiously optimistic, with FDI prospects hinging on macroeconomic stability, policy consistency, and of course, investor confidence. So that's the trend of our net foreign direct investment inflows for 2024. Okay, and in terms of placement of equity capital, we can see that most of the FDI coming into the country are going into the manufacturing sector for October 2024 compared to January to October 2024. So the manufacturing sector has been accepting bulk of the FDIs that are coming in to the Philippines. Now let's go to trade. Okay, let's go to trade. Now, Philippine trade flows in 2024 remained slow, relatively slow, with exports facing headwinds due to weak global demand, particularly from our key markets like China and the United States. Meanwhile, imports also slowed amid moderating domestic consumption and high interest rates. Though, capital goods and raw materials remained resilient, reflecting our continued investments in infrastructure and manufacturing. But despite these challenges, trade policy reforms, new free trade agreements, and export diversification efforts being made are aimed to enhance the country's competitiveness. And moving forward, trade recovery depends on external global economic conditions, improvements in supply chain stability, and of course, improvements in our local production capacity. So in terms of product category, different product categories showed mixed performance. And for exports, electronics, our country's top export remained dominant, but faced softening global demand, especially from China and the US. Agricultural exports, meanwhile, including bananas and coconut products, saw modest growth, while minerals and processed food exports gained traction. In terms of imports by product category, capital goods and industrial raw materials were steady, and this is driven by infrastructure and manufacturing activity. However, consumer goods imports slowed due to higher interest rates and cautious spending. And in terms of our trading partners, while there was a slowdown, China and the US remained a top trading partner. The US and EU continue to also become our key markets, while ASEAN and Japan played crucial roles in both import and export activities. Our FTA expansions with other economies, they're aimed to broaden market access and, of course, strengthen our trade resilience. So that's for trade. Now let's go to the movement of our exchange rate. Okay. The peso-dollar exchange rate in 2024 has remained to be volatile. And this has been influenced by global monetary policy shifts, trade flows, and domestic economic conditions. So early in the year, in 2024, so the peso faced depreciation pressures due to a strong US dollar. And this has been driven by the Federal Reserve's cautious stance also on rate cuts. But mid-year, improved FDI inflows and remittances provided some support that stabilized the peso. And by year-end, expectations of BSP rate adjustments and external trade imbalances led to fluctuations. But overall, the peso's movement reflected the external headwinds and domestic fundamentals, which policymakers, balancing inflation control and currency stability, are taken into consideration. So that's the movement of our exchange rate for an extended time period. But I just want to bring your attention to this particular slide wherein recently there was this news on the BSP's recent gold sale towards exchange rate management. So we plotted here the foreign exchange reserves of the Philippines versus our gold reserves. So again, as what I have mentioned earlier, no? So the BSP recently sold part of gold reserves, which is a move, no? Likely aimed at boosting liquidity and stabilizing the peso amid exchange rate pressures. And the sale perhaps provided additional dollar reserves, helping caution, no? Volatility in our exchange rate as global uncertainties and US monetary policy shifts influence capital flows. However, this aligns with our monetary authority's broader strategy of managing forex reserves to ensure market stability while maintaining policy flexibility in response to external shocks. And by leveraging our stocks, our reserves, it is actually a commitment to stabilizing the peso while ensuring sufficient buffers against global financial headwinds. Okay. And I have been warned that I have last 5 minutes, but I just wanted to go straight to, well, I have slides here on the performance of our neighboring economies and other major economies in the world. But I wanted to bring your attention to this slide. Okay. So the BSP is also closely monitoring the US Federal Reserve's policy decisions, as movements in the Fed rate often influence our capital flows, inflation, and exchange rate stability. So while the Fed hiked rates, okay, the BSP may follow suit to defend the peso and curb capital outflows, as higher US yields make dollar-denominated assets more attractive. So we're trying to manage the behavior of the policy rates in the US. Now, conversely, if the Fed signals easing, so the BSP will now have a room to cut rates to support domestic growth while balancing inflation risk. That's why it's very important now that we are all very much aware of how the Federal Reserve, how the US economy moves, because what I have mentioned earlier, they're part of our major trading partners, and any changes in the US economy would transmit to the Philippine economy, which would be an added variable for our policymakers to manage. And I just wanted to highlight this one also. Key trends in the Philippine markets for 2025 onwards, the sectors of interest would include renewable energy, infrastructure, digital transformation, and healthcare. Okay. So in terms of digital transformation, the adoption of AI would continue as AI applications are expanding across sectors, including BPO, retail, healthcare, enhancing productivity and innovation. The rise of fintech growth, and with more Filipinos embracing digital payments, fintech companies are now scaling operations, particularly in the underserved rural areas. So there are investment opportunities in digital banking, blockchain applications, and different online lending platforms. For infrastructure development, the Build Better More program would continue, prioritizing infrastructure investment, including new roads, bridges, airports, and railways, of course, with enhanced PPPs. Key projects, we're looking forward to the expansion of the Metro Manila Subway, the Mindanao Rail Project, which would spur economic development in Mindanao, and different major airport upgrades in the country as the Philippines position itself as a tourism powerhouse in Asia to attract more foreign tourists in the country. And with this, there are opportunities in construction, engineering, real estate sectors standing to benefit from these ongoing projects. In terms of energy transition and sustainability, the shift towards renewable energy sources gaining momentum, driven by the Renewable Energy Act and the country's global sustainability commitments. And with the rallying call towards sustainability across industries, many enterprises, developers are now focusing on green building certifications, energy efficient designs, sustainability accreditations as part of the Philippines' contribution to the Sustainable Development Goals. In terms of consumer spending and middle class growth, the resilient domestic demand with a growing middle class and young population, these segments would drive demand for consumer goods, real estate, and of course, financial products. As what I have mentioned earlier, with the rise of fintech companies, e-commerce and online retail would continue to thrive as more Filipinos embrace online shopping platforms, right? I mean, most of us here are into online shopping. Okay. And in terms of tourism growth, we are expecting the return of international tourists, and with relaxed travel restrictions, increased airline connectivity, alternative entry points, inbound tourism is expected to return. Okay. However, statistics have shown that 80%, at least 80% of tourism receipts are driven by domestic tourism. So there is the continued promotion of local destinations for locals, for Filipinos to sustain their travel that will drive growth in the tourism and hospitality sector. So with this, there are opportunities in hotel investments, ecotourism, digital platforms specializing on travel services. And in terms of agribusiness modernization, the inclusion of modern technology now, tech integration in agriculture is key. Agri-tech innovations such as smart farming, drone technology, and the Internet of Things are being implemented to improve productivity. Of course, government support on programs to enhance food security, and of course, reduce our import dependence. We're getting there. Okay, so there are opportunities in cold storage, supply chain logistics, and high value crops. And then just one last, on healthcare. On healthcare, the expansion of universal healthcare coverage would increase healthcare funding due to the growing demand for medical services, boost hospital and pharmaceutical investments. And finally, on hub for affordable medical services, particularly in cosmetic and wellness treatments. And on that note, I have to end there. Okay, I just wanted to call on Mr. Ruiz and Ms. Miral for final words, but these are the trends that we're seeing in the Philippine economy 2025 onwards. And Pia, Mark?
I'll go first. Thank you, Sir JP. First, I would like to recognize Sir JP and our other co-author, Ria Miral. I guess we emphasize some of the things that we have to look forward to look at addressing infrastructure gaps, further investments in human capital, and the continued drive for digital transformation and renewable energy, among many other aspects that we need to focus on. While we look at these drivers of growth as the country aims to attain upper middle income status, we need to consider we need to consider the recent developments and domestic and external headwinds that could hamper progress that is inclusive. Uh, Thank you, Ria.
So I'd like to take this opportunity to thank the audience for listening to the presentation on our study on the country's 2023 to 2024 performance and 2025 prospects. Like everyone, I look forward to the discussions, views, and exchange of ideas during the open forum. Thank you.
Okay, so on that note again, no, we thank everyone for your participation. No? Maraming salamat po at dagan salamat.
Thank you so much, Dr. JP. It is encouraging to see our economy regaining momentum, as evidenced by the rise in real per capita income and stable macroeconomic conditions. But there's a big but there. As you have presented, achieving full recovery to pre-pandemic levels really requires sustained efforts. Marami tayong tatrabahuin. So thank you, Dr. JP. And we also have heard some insights from Dr. JP's co-authors, Ria and Mark. Please stay online for the open forum. We will get back to you on that. I'm sure our participants have a lot of questions for you. So we encourage our participants to type in your questions. Please use the Q&A box on the Zoom platform. For those on Facebook Live, you may use the comment section. Please do not forget to include your name and your affiliation. Later in the program, we will invite Dr. JP and Ria and Mark to the open forum to address them. Now, let's deepen our discussion by inviting two industry experts as discussants to share their insights on the studies presented in this forum. So our first discussant is currently the research head and chief economist of Security Bank, where he formulates macro forecasts and leads the provision of research services to the bank's clientele. Previously, he served as Assistant Secretary for Economic Affairs at the Department of Trade and Industry, advising the DTI Secretary on competitiveness, consumer welfare, industry development, investment promotions, and trade policy. And he was also an assistant professor of economics at the De La Salle University and has consulted for institutions such as ADB, ASEAN, and GSIS. He holds an MS in economics and an AB in development studies from DLSU. So without further ado, ladies and gentlemen, let us welcome Mr. Angelo Taninco. You may now take the virtual floor, sir.
Good morning. Thank you very much to the PIDS for this invitation to share my views on the two studies that were presented. Kudos to the PIDS for this very important event, particularly to the two presenters, Mr. Corpus and Dr. JP. Around the two studies, and just to share first on what was presented with respect to the very timely and a valuable tool in order to assess certain shocks on the demand side, and also how this will have a bearing on the future economic trajectory of the economy, as well as policy implications. Indeed, three shocks that were conducted did insights on how we can understand better in a more systematic manner these effects at the macro level. Just looking at the current events, I would say that the model has important use also in terms of extending it, as mentioned by by Mr. Corpus, to incorporate certain dimensions, such as inflation expectations, also adding a supply block into the model. Could also be, I guess, used in order to understand how, say, current economic risks facing not just the Philippine, but more broadly the global economy would affect the demand condition. So specifically, many leaders around the world are very much cognizant of a looming escalation on tariffs and a potential tit for tat. This is now being studied closely by businesses on how a scenario like a global trade war could impact their operations. And I think this model could also be expanded to take that into account, how raising sharply, say, tariff, the country's external trade, both exports and imports, as well as its potential effects on the domestic economy. As we all know, Philippines is an importing economy, a net importer. So whenever import costs rise, and that could be driven by higher tariffs, then the inputs being imported by local businesses become more expensive. That could translate into a higher retail prices or so accelerate inflation, which Dr. JP pointed out has already been within the 2 to 4% target. So inflation risk may also rise as a consequence of a global trade war. So with that, it would be, I guess, very useful, especially for us in the business sector, to better understand how the transmission from a global trade war to the top line and the bottom line of businesses would take place. That's at the micro level, but at the macro level also how that can affect your economic growth, inflation, exchange rate, and also how their income status. If suppose you think that the progress for sustainable economic growth and achieving a high income status might be delayed. And talking about 2025 and beyond, as comprehensively discussed by Dr. JP, looking at 2024, and the Philippine economy, of course, ended that year on a healthy footing in terms of GDP, still outperforming most of its ASEAN peers, inflation now back to its 2 to 4% target, and policy rate cuts ongoing because we have already tamed inflation, given especially that food inflation has already gone back to single digit level, unlike before when it was at the teens level. So my take on the study shared by Dr. JP and his co-authors is that clearly we are still on that growth trajectory. We think that 2025 will be a better GDP year, largely because it's midterm election season. And when you look at the election year, comparing it to the prior non-election year, GDP growth tends to perform better during the election year. And that is quite understandable. Looking at the demand components, household consumption fares much better during the election year. Also, capital formation is stronger, and that's because there is more capital expenditures being undertaken by businesses. Government spending is not as strong, however, and that's quite understandable because of the election ban on public works. Trade tends to be better overall, both export and import. That's, of course, might be coincidental, not as clear as compared to the domestic side of the economy. So we are upbeat for this year in terms of GDP. We are likewise optimistic that inflation will continue to be within the 2 to 4% target. On a sequential basis, however, because partly you have base effects, we think that inflation might creep up. We saw that the January number. It was an upside surprise. And because now we might see more disruptions brought about by higher tariffs over the near term, that could also lead to higher domestic inflation, albeit modestly, for the near term. So no wonder, as Dr. JP explained, central banks led by Fed have been cautious in terms of continuing monetary easing. Just yesterday we saw Fed chair talking about the need to pause from rate cuts. They have delivered a total of 100 basis points of rate cuts last year, and in January, their first meeting for the year, they decided to pause. And we expect the pause to occur in their next couple of meetings. But we still think there could be a resumption of monetary easing. It's just that the Fed wants to be patient to bring down inflation back to its 2% target because currently it is still above that target. In contrast, the Bangko Sentral ng Pilipinas will have their first monetary board meeting later or today, and it is widely expected that they will continue to cut rates by 25 basis points to 5.50% today. That will be announced later in the afternoon. So since they started cutting last August, last year they cut a total of 75 basis points, and they will continue this with another 25 today. However, we expect also that our local central bank will pause from more rate cuts in the next couple of meetings because of the uncertainty caused by the trade friction globally that could again reaccelerate inflation and might also bring inflation expectations higher. So I think what's also important, equally important as discussed earlier about the types of inflation, headline and core, is also how would inflation expectations affect our spending outlook. I would think that if inflation expectations creep up, then consumer spending might be dampened. In fact, indeed, household spending continues to dominate the demand side. More than 70% of GDP is from household consumption. But for the past 6 or 7 quarters, we have seen the growth rate of household consumption underperforming of last year. GDP growth was 5.2%, but household consumption was 4.7%. So it might be because of the lag effect of inflation, but it might also be because maybe inflation expectation would be facing upside risk. So that needs to be closely watched, and that will have a bearing on monetary policy setting of our central bank. With respect to interest rates, there's also that uh, uh, view that inflation expectations might also be enabling current secondary interest rates or say government bond yields to be still relatively elevated. We saw, for example, uh, in the fourth quarter of last year, despite a 75 basis point cut by the central bank since August, uh, in, local bond yields still went up. So that appears to be counterintuitive. But that's again because driven largely by US Treasury yields rising sharply in anticipation that the Trump presidency could reaccelerate supply side inflationary pressures because of higher tariffs, as well as a restrictive immigration policy in the US that can catapult wage inflation in the US as well. And that's just on the supply side. But on the demand side, there are also plans to cut further taxes. So a combination of tax cuts and higher tariffs and restrictive immigration policy all lead to higher inflation and inflation expectations. So I think that may also need to be closely monitored as well, how that is affecting not just the US, but the rest of the world, including the Philippines being a net importing country. Uh, Lastly, going back to the trade war, I think there are opportunities for the Philippines. We know that we are heavily reliant on electronics exports. Trump, the President Trump of the United States, wants to raise tariffs on aluminum, steel, and also semiconductors, which is a huge part of electronics. So that's why stock markets in those economies that are heavily dependent on electronics, such as South Korea, Taiwan, and of course China, they have been dampened by such news and potential risks. So given that, it would also be nice, at least from a macro model point of view, to see the sectoral implications of such a global trade war. Within the Philippines, I would surmise that electronics, automobiles, transport equipment, and the like, those widely tradable products of the Philippines will be adversely affected by a global trade war. And to end my discussion, I congratulate the PIDS for the two studies, and I hope that they will continue to do more of these studies, extending it, expanding it, in order for us, the business community, to appreciate more and use it for our own decision making. Thank you very much.
Thank you for your comments, Mr. Taninco. Please stay online for the open forum. So now let us get to know our second and final discussant. He is the group economist at SM Investments and has extensive experience in research economics and data analytics across government, academia, consulting, banking, and private sectors. Previously chief economist at a major universal bank, he consistently ranked among Bloomberg's top 3 analysts for Philippine inflation and BSP rate forecasts. The Asset Benchmark magazine named him the Philippines' #1 economic researcher in 2024. He holds an MS in economics from De La Salle University, Manila, where he taught financial economics and econometrics. So please welcome Mr. Robert Dan Roses. Dan, you may have the floor.
Thank you, ma'am. Can you hear me? Just checking.
Yes, we can hear you loud
Okay,
and
good. Hi. Okay, so good morning, everyone. Thank you for that comprehensive presentation on the small macroeconometric model and the Philippine economy's journey towards upper middle income status. So I think we're not just reading numbers, we're watching the story of 100+ million Filipinos actually navigating through the global and local economic headwinds that we're seeing right now, while at the same time we're trying to climb the development ladder. And speaking of that climb, let's look at where we are on that journey. Actually, the Philippines' 5.6% growth in 2024 is telling us something important. Now, we're running a marathon and not a sprint. It's interesting that while we did fall short of the 6 to 7% target by the government, there's a bigger picture actually here that deserves our attention. Think about it. Now, we're still outpacing many of our neighbors while facing the same global challenges emphasized by Jello earlier. So it's like trying to run uphill during a storm. No? So, di ba, pag bumabagyo, hirap tumakbo dahil sa hangin, di ba, mga headwinds natin. The pace might be slower because of that, no? But we're still moving forward. But here's something also interesting. GDP numbers are like social media profiles. So they don't really tell the whole story. The real question isn't just how fast we're growing, but who's benefiting from this growth. So are we building an economy that lifts all boats or just the yachts? Meaning, is it inclusive? Is it for everyone? Or is it for a selected few? That brings me to something crucial that was touched upon in the both in the presentation. The policy landscape that we're navigating is actually fascinating, no? Yung mga tightrope walker, no, sa circus, no, yung nagbabalance sila, no? They try to maintain perfect balance. That's exactly what the BSP is doing right now, no? So they kept steady with rates at 5.75%. They may or may not cut later, but they are watching every slight breeze in the economic winds. Especially in an election year, local election year, you have Trump 2.0, you have local inflation, and geopolitical issues. And while we're talking about balancing acts, there's another crucial one we need to consider. The 1 trillion peso allocation for climate adaptation isn't just spending. No, that was also highlighted in JP's presentation. It's an investment in our survival. In the Philippines, climate change is a future threat to today's reality. It's a major cause of inflation. Actually, if you look back 2-3 years, no, all the food inflation that we're seeing was born out of typhoons hitting us right when we were harvesting. No? So it's a major cause of inflation. With that allocation, we're finally putting our money where our monsoons are, no, so to speak. But challenges often come hand in hand with opportunities as well, di ba? Let me share something exciting that I don't think we're talking about enough. The Philippines isn't just adapting to the digital age. No? We're actually helping write its next chapter, be it via export, be it via the service that we do. Picture this. When a sari-sari store owner can access digital payments and online marketplaces, we're not just growing the economy. No, we are actually revolutionizing it from the ground up. And this revolution isn't limited to retail. Take our semiconductor industry initiative. We're not just joining a global supply chain, we're embedding ourselves actually into the world's technological nervous system. No? Now, major headwinds mentioned earlier, yung mga tariffs that were imposed by Trump, which will necessarily affect our major export, which is electronic components. No? But having said that, no, those are headwinds that we have to be able to weather. We're not just joining a global supply chain, we're embedding ourselves into the world technological nervous system again. No? So the main components used by NVIDIA and other CPUs, GPUs that are being used widely as of now, most of the components have been manufactured here in the Philippines. So as we look toward the future, all of these pieces actually start forming a clearer picture for us. So three key thoughts keep emerging from our discussion today. First, and this is crucial, our growth must become more inclusive because an economy that works only for some will ultimately work for none. You know what else? Climate resilience isn't just about survival anymore. It's becoming our competitive advantage in a world where sustainability isn't optional. And finally, this might come as a surprise. Digital transformation isn't just a sector of our economy. It needs to be the foundation of all sectors. So let me leave you with this thought as part of the closing. The Philippines economic story, both in 2024 and 2025, isn't just about managing headwinds. No, it's about harnessing them to fly higher or to allow us to fly higher. The real question isn't whether we'll reach upper middle income status somewhere down the line. No? It's what kind of economy that we will be building along the way. Thank you very much for your time. Good morning.
Thank you for your comments, Dan. So please don't go away. We hope to hear more insights from you during the open forum. So before we start the open forum, I would like to ask Dr. JP. Dr. JP, what are your thoughts on the comments of our discussants?
Hi, so I would like to thank Mr. Tanincono and Mr. Roses for being our discussant. And I would have to concur that, yes, the economy is just beyond managing headwinds. It's an entire system of its own that requires both managing, maintenance, monitoring, and these different parts of the systems would have to be taken as a whole so that more stringent and more effective management policies would be implemented so that the growth in the economy can also be transmitted or diffused to households so that they can also feel the growth figures that we are talking about.
Thank you so much, Dr. JP. Very interesting indeed, no? So we now invite our presenters and discussants to open their cameras for the open forum. For our audience, if you have questions, please use the Q&A box on Zoom webinar. And for our Facebook Live participants, you may use the comment section. Do not forget to include your name and your affiliation or organization from where you're from, okay? So to set the ball rolling, allow me to read some of the questions asked in advance by our registrants. This one is from Mr. Rimar Mindanao of DepEd. I would like to address this question first to Dr. JP, because it has something to do with your study. How do positive economic indicators translate to tangible benefits for the majority of Filipinos at the lower end of the income bracket? Who stands to gain the most?
Hey, where's the question again? Oh, here. Again, can you repeat the question, please?
Sorry. How do positive economic indicators translate to tangible benefits for the majority of Filipinos at the lower end of the income bracket? Who stands to gain the most? Sorry, these are some of the advanced questions from our Zoom registration.
Okay, so to answer that question, again, we're talking about indicators, and there are a lot of economic indicators to show economic performance, but then the variety of indicators, it's not complete. It does not really reflect everything. That's why I was talking to a participant earlier through the Q&A box, and we're talking about the indicators. And while GDP, for example, GDP growth may not be able to capture an entire picture of how the economy grows and whether this growth is being transmitted to the households, to the lower end of the income bracket, it is very important as well to look into other indicators so that we know that this growth is really being translated into tangible benefits. Like, for example, Human Development Index, access to education, access to healthcare, access to social protection. And if we see that these figures are high as indicators, then it gives us a clue or a sign that the growth that we are experiencing are actually being translated into something that's tangible, that is being felt by our common Filipino people. So that's why I also recommend that we look into all the socioeconomic indicators beyond GDP.
Thank you for answering that question, Dr. JP. May I ask some experts on their thoughts on this question as well? Are there other indicators that you think should be included? Mr. Roses, do you want to comment?
Yeah, well, I think so we're slave to the government data that we have, and also sometimes, if you ask Jello, if you ask JP and all the other researchers here, we always wish for the data quality, and the data timeliness that the US has, no. So, but again, we're slave to only what's available to us now. So we need to look for alternative data set for that. But I think the number one, well, for one, if you want the tangible measure, if the economic benefits are already being transmitted or trickled downward, no? To the poorest, probably I would say access to healthcare, which will be number one, which is number one priority among them, no? And a source of major burden. I think if more of those in that income strata is actually visiting the hospital, no, that would be a sign that they are more confident about their ability to or inability to make it sort of a financial burden. No? So, in short, no, pagka hindi mo na problema yung pagpapagamot, no, pumupunta ka na on your own willingly, no, that could be a very good indicator as well.
Yeah.
It hits the poorest the hardest. The other one, well, of course, rice is life, no, for everyone, no, not just the poor. So I think we have to move beyond that. But yun, for me, I think it will be healthcare as a very good tangible measure. But sadly, it's very difficult to get that data yet. No? But yeah, we can only hope.
Thank you for that, Mr. Roses. Indeed, healthcare is really one of the indicators that we can consider. We also have a question here, and I'd like to address this to Mr. Taninco. This is from Mr. Andrew Cesar Rimando of the Lorma Community Development Foundation Incorporated. The question is, how do the additional tariffs imposed by the current U.S. administration on imported goods impact the macroeconomy of the Philippines?
Thank you for the question. Indeed, it will be much better to have, well, first, a comment, a macro model simulating that kind of shock of a global trade war, as I have suggested earlier, to have a more systematic view on the underlying macro effects of higher global tariffs and its effects, especially on importing countries like the Philippines. But to my mind, I think, as I mentioned recently, uh, this will have not just macro, but also sectoral and job impacts. Just as an example, higher tariffs imposed by the Trump administration are firstly confined on select items such as aluminum, steel, semiconductors, and focusing on just those three, semiconductors is our biggest merchandise export item. More than 50% of our merchandise exports are from that sector. So electronics sector also relies heavily on imported electronics parts coming from East Asia and other parts around the world. So it's a huge supply chain globally. Philippines being a part of that supply chain, so it will have worldwide ramifications on the global electronics and semiconductor industry. So effects would be lower exports from the Philippines, especially on electronics, job losses in the electronics sector in the country. And since is very positive for GDP growth, then this will constrict our GDP growth. So what could be the other potential effects? Well, we have to have a better perspective also on what the electronic sector would have an impact on the other industries. So there could also be intersectoral effects coming from that higher tariff globally on the electronics alone. So I think that also warrants more study, an intersectoral and even output and employment effect of a tariff imposed on a critical export sector of the Philippines, such as electronics. But ultimately, it's negative for our economy.
Yeah, that's insightful, Mr. Tanigor. Imagine there are intersectoral effects by just one sector's additional tariff. No? Imagine how impactful would that be for our economy. Now, let's proceed to our um, questions from Zoom. No, some questions on Zoom have been addressed by Dr. JP a while back, but to allow our FB live viewers to hear the answers, let me just read the questions and then address them to Dr. JP. Will that be okay? Okay, so we have here from Derco M. Rosal of Manila Bulletin. The question is, given the disappointing growth in Q4, the full year of 2024, do you think your 6.1% projection remains achievable? How about the upper range of the government's 6 to 8% target? And then the follow-up question would be, what are the top stumbling blocks to achieve this target? Dr. JP?
Okay, so let me just share my answer to Mr. Rosal earlier, no. Yeah, while we have a disappointing Q4, no, in full year 2024 GDP growth, personally, no, based on statistics and based on the economic environment that we have, how sensitive the Philippines is to headwinds, to opportunities as well, it is always possible that we can achieve that 6.1, even higher. However, it is always conditional on the right policy interventions. Policy interventions, the implementation itself of that policy, and of course, how the external conditions aligns favorably with the Philippines. That's why I agree, no? I agree that the Philippines should always diversify its economic activities with its trading partners, would also strengthen internal economic constraints in the Philippines, and hitting the 6 to 8% target would always require stronger momentum, particularly in key sectors, and improve domestic and global conditions. When I say key sectors, one of the questions earlier that I answered is that key sectors where the Philippines has comparative advantage. resources can be focused on these sectors that can generate greater multiplier effects for the economy. And this only be implemented, can only be done if the appropriate policy environment is there. If the commitment, if the nation, if the then reforms would be accelerated, inflation can be managed, and at the same time, the Philippines can project itself as an investment destination for both local and foreign investors. So it boils down to policy.
Maraming trabaho ang ating mga policymakers to achieve that goal. May I ask, Mr. Taninco, what is your comment on this? I mean, given the growth in Q4 na hindi masyadong, maganda. So what do you think? Kaya ba?
Well, as I shared earlier, it's an election year.
Yes.
And historically, most of the time, not all of the time, most of the time, election year leads to faster GDP growth than the prior non-election year. Now, of course, a presidential election year provides stronger GDP growth than a midterm election year. But still, this is, this bodes well for demand. We look at it across components of demand, and it's household consumption and capital formation that will grow faster historically during an election year. Government growth, spend growth will be less because of the election ban. On the sectoral side, if you look at the 15 sectors under GDP, majority have outpaced GDP growth in recent years. We have the likes of construction, finance, accommodation, food services, transport and storage. The laggards, like agriculture, manufacturing, we think will be the same this year, meaning to say, those sectors that outperformed GDP growth last year will likely outpace GDP growth again this year. So, of course, we have a potential trade, but as I mentioned, electronics is part of food manufacturing, and manufacturing has been a laggard in terms of growth in recent years. So my point is the 6 to 8% target is feasible. Our own estimate is close to the lower bound of the target at around 6.1% for this year. If the magnitude of, say, election spend is stronger than anticipated, thanks to low inflation, thanks to rate cuts, etc., then you could see a higher upside on the GDP growth this year compared to last year. So last 2 years, it was flat, 5.5 2023, 5.6 2024. But what we are arguing, together with the consensus in the market, which I think is looking at 6%, the lower bound of the target range for this year, is that despite the headwinds, it's feasible to now come into the target of government of 6 to 8%.
Wow, very positive outlook there, Mr. Taninco. You mentioned about agriculture a while back, so I will relate this question from the Department of Foreign Affairs. This is from Deputy Director General Kerubin Lakay. This is for Dr. JP. Dr. JP's emphasis on agricultural development is critical. It could be the key to the country's resilience, inclusivity, sustainability, among others. In light of this, what do our experts think are 3 essential policies that the government should adopt to stimulate agricultural growth? So I'll address this question first to Dr. JP, and then I also ask this same question to Mr. Rosas and Taninco in a while.
Okay, so thank you so much for that question. I've been a supporter of agricultural modernization. That's why policies on top of my head right now in terms of policies that can ensure resilience, inclusivity, and sustainability in the sector, be number 1, agricultural modernization, and of course, infrastructure development. Why? It's because outdated farming methods inadequate irrigation, even yung ating weak post-harvest facilities, it actually constrains productivity. Second, I told you earlier in my response to your question regarding land consolidation and agribusiness incentives. And this is because the fragmented land holdings, please correct me if I'm wrong, the fragmented land holdings actually limit economies of scale. It reduces efficiency and profitability of farmers. And then third would be, and this is one of my quote unquote advocacy in terms of policy, is to strengthen the supply chain, strengthen market linkages, strengthen the value-added processing of agriculture. It's because, again, you can correct me if I'm wrong, I can see that farmers struggle with low prices. Not only with low prices, but farmers are also struggling in terms of market access, even competition from imports. And a low-hanging fruit here would be for example, the Kadiwa farms, providing really the access to the market, putting the produce close to the market actually facilitates the sale of farm produce, and at the same time mitigate the loss in production due to spoilage and so on. So those three are critical in advancing the agriculture sector.
Thank you, Dr. JP. How about Mr. Roses? Your insights, please.
Yeah, thank you. Adding on to what Dr. JP said, I mean, it goes hand in hand. We have to modernize the farming methods. Part of that will be something that the farmers currently are very hesitant to do, in mechanization, because they think that some of their co-workers will suffer from it when they modernize, which isn't the case. Actually, it's going to, I guess you just have to, they just have to realize that it's going to give higher yield. So, number one, yan, mechanization. Second is probably more, we're getting battered by monsoons and stuff. So, climate change solutions will also be directed towards our agricultural side. So, it's not just about, flooding sa Manila, flooding sa urban areas. It also affects the farmers. So, that actually goes hand in hand with improvement in supply chain. But the supply chain is also hampered by middlemen. So you cut the middleman, you provide, I know there's this initiative by a large online, it's not online lending, it's online, something that we use popularly to pay for stuff. So I can't mention it here, pero I know that they have this initiative already that they lend to farmers directly, and then very low, if not zero risk at all. So what happens is that the farmers are not made to go to the middleman for loans. I mean, pang school lang, kunyari pagka walang ani, kailangan pa nila umutang
Yeah.
Sa middleman para sa pang tuition ng anak, for school stuff. So dito, hindi na nila, it cuts the vicious cycle of dependency towards the middleman. So dito they can probably lend, para micro-lending initiative directly and then pay off eventually. So that's a good initiative. It just probably needs more, it needs more inroads to do, but at least there's that initiative already. So yun, kasi it's a vicious cycle of dependency. It's been hampering the agricultural side as well. So yun, those are my thoughts.
Thank you, Mr. Rosas. There are policies in place indeed, but it appears that the policies need some review to further strengthen our resolve for food security. Mr. Taninco, would you like to add to that?
Yes, I fully agree with Dr. JP and Mr. Dan Roses on the need to enhance supply side, improve agricultural productivity. And that, of course, entails better policy making and also the implementation of these policies towards a better agricultural sector. But I think the fuller benefits of this would be in the long term. But just to add, I think the question came from a foreign affairs perspective, and Dr. JP touched on market access. So just to give a specific example in the agriculture sector, we know that the Philippines is one of the biggest banana exporters. in the world. We used to be, I think, number one. And just to give, I think 2019 was our heyday on banana exports. We were exporting heavily bananas to the likes of China, Japan, South Korea. And since then, we were not able to maintain that, record high exports. Partly maybe because there's some geopolitical issues. And this was cited by the likes of the Food and Agricultural Organization in their latest report on the global banana trade. So I think that there is also, from a foreign affairs perspective, to, I guess, address the geopolitical impact on our banana trade, to reinvigorate it and to gain more market access into these our top trading partners in the region. And we currently have, of course, the free trade agreement within ASEAN and also East Asia, and we can promote, more bilateral FTAs. Of course, there are in talks of a potential Philippine-US FTA. We recently signed the Philippine-Korea FTA. So, and we want to have more of our banana exports into Korea. And so I think there is those kinds of opportunities that will, I think, encourage or motivate exporters and allow them to also take part in increasing the production side, because we cannot export more if there are certain limitations on our local production in the banana sector and more broadly in the agricultural sector.
Thank you, Mr. Taninco. We have another question here from Mary Angeli Tulawan of the Bureau of Treasury, and I'd like to address this question to Mr. Ross. No? So I have to read her question. As the foreign exchange between the US dollar and Philippine peso increases, which already multiplies the rise in inflation and cost of imported goods, what government agencies and policies could be utilized to alleviate the impacts of inflation and increase the cost of goods to ordinary Filipino? Mr. Roses?
That's a very tough question to answer because we've been talking about the interplay between the sectors, between government policies, between all the other supply side and demand side as well. No? But I think, given that the question was more geared towards FX, actually, the fluctuations in the foreign exchange has more, the jurisdictions actually has something to do with the direction of the DSP. So, long answer short, if you want to control, the fluctuations, it has to be the DSP. But the DSP is not really mandated directly to intervene with the direction of the foreign exchange. So it's mostly about market forces pa rin, but they can do it via the GIR or via the policy rate. Now, having said that, business confidence is actually very important to consider because business confidence is more affected by FX fluctuation, mostly because firms are geared towards importing. Most of the larger firms are importing, so they are more sensitive to FX instability. Consumer confidence, on the other hand, surprisingly, is more affected by movements of the policy rate. So and also inflation. So yung policy rate, what's surprising because it should have affected the businesses, but the businesses were quick to adapt to the expectation that the rates will be high, so okay lang sila doon. But it's the instability of the FX that has been eroding business confidence as of late. You take a look at the Q4 business expectation. It's a different data set, but business confidence is actually more sensitive towards FX stability, partly because it affects the planning. And businesses have to plan long term. They're active as how consumers would do it. So I guess Um, uh, the answer to the question should be, BSP being more watchful about how the policy movements and geopolitical uh, developments actually affect us. So yun. Yeah, I think that's one government agency. I can think of another one. There's no direct government agency that's in charge of the effects rather than the central bank.
Thank you, Mr. Roses. Naku, ang dami po nating questions, but due to limited time, meron akong last three. Okay lang po ba? Last three question. This is from anonymous attendee, and I'd like to address this question to Mr. Taninco. Regarding climate change and its impacts on Philippine economy, how are we seeing the Philippines addressing climate change issues via meeting the Sustainable Development Goals? Specifically, how can the government leverage its green and blue economies despite the impacts of climate change?
Well, I think at least from the private sector's point of view, I think now there are calls for financing those businesses that tend to be environment friendly, raising funds through, let's say, bonds that have sustainable bonds that tend to be also consistent with the spirit of the ESG. So I think there are efforts being made, but clearly I think more broadly there's a need to have more familiarity on especially amongst the businesses on how such mechanisms such as in the area of financing or even just the business culture per se, like not using much of, say, plastics, or simple as segregation. Those kinds of micro practice and culture would cascade towards the organization in a business, and therefore let the stakeholders be more appreciative of such efforts, and that I think could spill over at the macro level. So Philippines will now be seen by foreign investors more as an economy that is practicing what it preaches when it comes to ESG, and promoting better climate change policies, strategies, and programs, not just for their own organization, but on also uplifting this to to the larger macro economy. But I think that kind of appreciation would take time. It's not overnight, and it's not just a unilateral effort. I think we also need the support of our partners in the region and also our partners outside the ASEAN region more globally. And we need to be more active in these kinds of promotion as an individual, as an organization, and as a country, so that we can be seen as a proactive member of the community when it comes to promoting climate change.
Thank you for that, Mr. Taninco. I have another question. You mentioned a while back, Dr. JP, about the changing of skills necessary to address the VUCAD world, no? So with the growing prospects of IC-related jobs and the rise of AI and the latter's capacity to replace human labor, if you were part of the policy-making body of the government now,
Well, yeah, I think I answered that earlier, but with the rise of AI, machine learning, all these new technologies, I always see this as a change on job profiles. And I am a firm believer of capacity building, capability enhancement, training. And there are a lot of training providing institutions in the Philippines right now offering programs on these technologies, which we should adapt. But the challenge here is, are we really willing to change our perception of this technology? Because as of the moment, there's still a huge segment that is hesitant on these technologies that would warrant also their hesitation to take further training, to learn further these technologies. That's why, on top of head, no, training is always key. We need to get to know the technology that we are facing. And this is actually the same feeling, I suspect. This is the same feeling that we felt when Google and Yahoo was on the rise before. Imagine you don't need library cards anymore during the time. And that feeling of hesitation, that feeling of anxiety, for me, maybe it's the same feeling that we're having now with AI, with ChatGPT, with DeepSeek, no? That's why we need to get to know them so that we know how to manage them so that they do not replace us. We have to be smarter than AI, and we can only get that through training and education.
Yes, I definitely agree, Dr. JP. The education sector has also to rethink how they can modify the current curriculum to
And you do not
adjust to
resist
this
it. The more
demand.
you resist it, the more it will make your
Yes,
life difficult.
exactly. Let me hear your thoughts, Mr. Rosses and Mr. Tanigo, to be followed.
Yeah, that's very interesting. Kasi we can go back even further, no? During the Industrial Revolution, a lot of people were very hesitant about the rise of the machine, no?
Yeah.
So even predicting that it will replace workers. And so, parang, actually, we've heard that before, no? Sinasabi nila, papalitan tayo niyan, ganyan yung machine. Mawawala ng trabaho, maraming tao, magugutom maraming tao. So that didn't happen. So it gave rise to two kinds of society. One is the Luddites. So sila ay resistant to technological change. Look where they ended up. The other one, those who adapted to it. So I think the key word is adaptation. No? We have to harness, again, I agree with what Dr. JP said. We have to be able to use it to our advantage. No? I mean, it will cut a lot. There will be some job replacements because of that. But it will also create jobs as well, no? In relation to that, similar to what happened during the Industrial Revolution. So I think it's just being smart about it. Um, you know, we've had the benefit of movies, the Terminator, pagka nagkaroon na ng Skynet, uubusin niya ng humanity. It's not necessarily that. I mean, the AI technology still needs human intervention from time to time. So
Yes.
it just makes probably it will make your work a lot easier, no? But still the human factor will be there. No? So there will be some evolution down the line in terms of employment and also demand for some workers who might be skilled with it. No? So I agree. The first step that we have to do is to be able to overhaul our education curriculum. In some schools already in elementary, they're learning Python programming. No? Eventually, Python will be as ubiquitous as Excel was during our generation. No, so Excel before it didn't exist. At least when I was in elementary, even high school. No? So lumabas na college. We've been using it extensively in the workplace. And then ito, incomes, yung mga coding languages. So kids are learning it already. So some kids are learning it already. So there's some progress there, but I think it has to be scaled up. Lest we become laggards again in terms of adapting to the possibility of AI being more ubiquitous than it is right now.
Okay. Actually, I think the reason why people are so afraid of this technology is because of the fear of the unknown. They do not know what will happen next. Mr. Tanigo, comments?
I fully agree on the need to adapt AI. But the reality, I think, is that this will take more time for it to be fully adapted, especially in a developing country setting like the Philippines. Recall the flying geese strategy in which new technologies occur first in rich and advanced economies, and then you have that spill over into the emerging markets once you have multinational companies from advanced economies investing more into these countries, establishing their subsidiaries, affiliates, and the like. In fact, in the US, AI is being used as an investment, but investors are still waiting for the AI investment to be fully seen in their top line and profitability of these companies. So they are already still in that stage. Whereas Philippines, of course, we're talking about it. There are lots of seminars about it, etc. I mean, I fully agree with Dr. JP on the need to narrow the skills mismatch. But then again, the reality is there are certain sectors that will still be labor intensive, not just given if you have AI now here, you still have those kinds of labor intensive industries. And those that are closer to adopting AI, such as let's say the IT BPM sector, we are still upbeat on that sector. We still think they're going to grow close to 10%. They're going to be a export proceeds generator still. And that's because there's this complementary, I think, that's happening in terms of adapting to such new technology and the maintenance of the workers who are still relatively young. So we still have to exploit our favorable demographics, being the youngest working class in the region or maybe in the world, and how such young workers can adapt, not immediately, but I think more gradually into these kinds of technologies. But in the meantime, I think there's still a transition period, and I think such transition will take place in such a way that there will be no job losses occurring as we adapt a new technology, but rather more complementary taking place in the work, in the office, or say in the home hybrid setting on need for AI on one hand, and how the worker continues to work with such kind of new technology in his or her workplace or work at home place.
Sabi nga po, technology is moving faster and the government is trying to keep up. No? Medyo mahirap na dynamics. Our last question, and request ko lang that each one of you would answer this one. From Chairperson Marilu Mendoza of the Tariff Commission. Kasi kanina we had a question, what risks are you most concerned about this year? Kayo po, ano daw po ba ang risks na sa tingin ninyo ay we should be concerned about? Let's start with Dr. JP. Yes.
Well, personally, the risks that I am very worried about right now are the external risks, particularly the conflicts that may arise, particularly in Eastern Europe and in the Middle East. Because historically speaking, any conflict that happens in that area of the globe diffuses to the Philippines through inflation. As we all know, we are very dependent on oil, and any conflict outside the country would first and foremost attack oil prices. And as a country dependent on oil, all our systems are threatened by that simple change, by that shock that happens due to external risk. For internal, I have always believed in the capacity of our policymakers in managing our economy. Both public and private sector, they collaborate on the economic forecast, contributing on the discussion of how to move forward the economy. And I have trust. I have trust in our economic managers, both public and private. We are in a better position to manage our economy, but the uncontrollable factors coming from the global risks is very threatening for me.
Thank you, Dr. JP. Mr. Roses, your thoughts?
Yes, essentially the same. No, a lot of the problems that we experienced the past 2 years was mostly because of external forces. No? So, yun, outbreak of Russia-Ukraine war, shot up wheat prices, and then that eventually led to global inflation, then local inflation. So, at the moment, I would say external threats. So, yung trade war that could affect us, and as what JP mentioned, we are a very import-dependent country. We import oil. Now we're importing most of our food stuff. So any external shock will definitely affect us. So that's the risk that I'm most worried about. How the current geopolitical risks are panning out. So something that we have to watch out for.
Interesting insights. Mr. Talinco?
Thank you, Chairperson Mendoza from the Tariff Commission. I was with her when I was at BTI a few years back. But my main risk right now is similar to what we saw in the 1930s. It's a global trade war. And we know what happened based from our history, how that trade war led to in the 1930s a Great Depression. That's the worst case. It's a tail risk. But if it escalates, then we have to see the implications and repercussions, not just on the macro level, but on the sectoral level, whose jobs will be affected more, and how do we make use of certain policies to safeguard those vulnerable sectors and to, while maintaining our advantage in other sectors.
It really boils down to policy, right? So we're now in the final stretch of our program. Before we officially wrap up, we'd like to hear some closing statements from our presenter and his co-authors, as well as our discussants. So let's start with Dr. JP, followed by Ria, Mark, and then our discussants, Mr. Taninco and Mr. Roses.
Okay. First of all, I would like to thank all our participants for your questions. They're very challenging, they're very interesting. They stimulate the discussion on how we can move forward with our economy. But from my end, let's continue to become optimistic about our country, about our economy. It's because it is through this optimism that we are able to move forward together as a nation. And the economy is part of our lifeline, and contributing to economic growth is everyone's duty. We have a role. We have a role in our economy, and contributing to it in our own little ways could help propel the economy towards upper middle income status in the future. Maraming salamat po.
Thank you, Dr. JP. Ria?
Hello, good morning still. So I'd just like to thank everybody involved in today's webinar, from of course the presenter, our boss, Doc JP, and my teammate Mark Ruiz, and everybody from the RID department of PIDS, and of course our discussants. Thank you very much for all the valuable insight. And of course, the attendees as well. The presentations and discussions were very lively and informative. And since this is an annual publication, we look forward to seeing everyone again next year. Thank you.
Thank you, Ria. Mark?
I would just like to thank first JP Corpus for presenting the study on the macro model. Of course, the discussants, Mr. Tanico and Mr. Roses, and Sir JP and Ria for this for the paper that we were able to come up with, and also to the participants and all the questions that were discussed in during this webinar. We look forward to the same webinar that we will be having next year. Thank you.
Thank you, Mark. Mr. Taninco?
Thank you very much to the esteemed PIDS led by Dr. Babes Orbeta, also Melinda, and also to the speakers, Dr. JP and Mr. Corpus. I congratulate your efforts in enhancing the research of the PIDS and also disseminating it to a wider audience. And what I really like about this kind of research is that it's forward-looking. As an economist, we have seen many studies that use backward-looking data and basically summarizing what has happened. But I think there's a need for more forward-looking type of research, what lies ahead, prospects, outlook, because this is going to be very important and useful, not just for the business community, but more also on the government leadership, and to understand how such scenarios like policies on tariffs and the like could affect the local economy at certain sectors in order to craft better policies and decision making that will continue to sustain our growth trajectory, which we still think, at least from a business point of view, is going to be positive, going to be an outperformer in the region, going to manage well inflation and foreign exchange volatility, and lead to lower borrowing costs in terms of monetary easing and the like. In the end, the goal is to promote jobs and to sustain that long run economic growth of 6% or more. But as an input, forward looking research such as this would be very useful.
Thank you for the inspiration, Mr. Taninco. Mr. Rosas?
Yeah. Thank you very much to the PIDS for inviting us here, no? And also congratulations to the authors and presenters on doing such a very important research and also sharing it to the public. No? So yeah, once again, PIDS, think tank of the Philippines. You've shown your way again. You've shown your worth. No, so we're very fortunate to have been part of this endeavor. And me speaking not just as a discussor but also a participant. It's very very useful to me. No, sa economics kasi, yeah, like what Gerald said, we're used to reading a lot of descriptive studies, but at least now the what should be is being discussed, no, and that's very very important, no, to our economy moving forward. So, I guess keep up the good work, and we're excited to see more of the public webinars that you have planned along the way. Thank you very much.
Thank you, Mr. Rosses, and thank you very much to our panel for the valuable insights and to our audience for their active participation. Let's give everyone a big round of applause. Yeah, and so before we officially close the program, let me announce the raffle winners. For those joining our event for the first time, the PIDS team selects 2 winners from the Zoom audience and 1 winner from Facebook. So the team has prepared some tokens for you. Surprise daw yun. So I'll be announcing your name now. From Zoom, we have Mr. Derco M. Rosal of Manila Bulletin. And we have Miss Neri Angeli Tulawan of the Bureau of Treasury. And from Facebook, Mr. Romel Sanchez. Congratulations to all the winners. Please expect a package from our PDIS tech team. They will coordinate with you on how to claim your prizes. Okay, so once again, we appreciate your attendance today. Don't go away yet. I still have few reminders. The speakers' presentations will be available at the PIDS website. Visit www.pids.gov.ph/events. And you can download a copy of the study from the link provided in the Zoom chat box and Facebook comments section. So we want to hear your thoughts about today's program. Please help us improve our events by answering our feedback form through the link provided in the Zoom chat box and Facebook comment section. Please note that the e-certificate of participation will be sent to your email automatically after you have submitted the completed feedback form. Your feedback and recommendations will make our upcoming events better. So keep in touch with us as well. Follow PIDS on Facebook, Twitter, or X, and YouTube channels for more updates. Also, feel free to visit our websites for more information. And we hope to have you again in our future events. Join us in another event on February 19, 2025, led by the Philippine Apex Study Center Network in collaboration with the University of San Carlos. This is a hybrid symposium titled Shaping Apex Blue Economy Agenda, Philippine Leadership and Visayas-Centric Innovations. This event will be held at the University of San Carlos, Talamban campus in Cebu City and online via Zoom. Please visit our webpage, www.pids.gov.ph/events to learn the details of our upcoming event and on how to register. Finally, we would like to thank our participants from the government, private sector, academe, civil society, and international organizations. We hope today's discussion gave you valuable insights into the Philippines' economic outlook and the role of fiscal policy in sustaining growth. Your participation helps deepen our understanding of the challenges and opportunities ahead. This has been your host, Melinda Quinones. Thank you, everyone, and have a great day.
Thank you.